How do I select the right impact player for my portfolio so that I am in the profit every time? Welcome to another exciting episode of Waltz with Walunj, the show where you and I will waltz our way into the mysteries of building real wealth, one episode at a time. I'm your host, Sandeep Walunj, the man from Motilal, Oswal, and today we're going to be tackling a question uppermost in every investor's mind. How do I be sure of selecting the right asset class at all times? You see, investing is a lot like cricket, but then you don't send your power hitter out in the first over of a test match. Just like you don't put all of your money in a small caps right after a recession. But unlike cricket, there are no clear power play overs in investing. So how do you decide whether to go in for that stable large cap or the promising mid cap or the aggressive small cap or the wild card, the commodities? Pad up, because by the end of this episode, you could be making smarter money moves than ever before. Think of the economy like a cricket pitch. Depending on the conditions, different players have a higher chance of shining. Large caps are potentially the more reliable players. These are typically your orange caps or purple caps. They are steady, dependable, and they perform even when the pitch is tricky. Large caps thrive in uncertain times, rising interest rates, and moderate growth. For example, remember 2020 when the markets crashed? Large caps were the first ones to rebound, just like how an experienced opener steadies an innings after early wickets fall. Mid caps are the all-rounders. These players typically shine when the game picks up momentum. Mid caps do well, therefore, in economic expansion when GDP is rising and the interest rates are low. For example, from 2014 to 2017, India's mid-cap index outperformed the large caps by a handsome margin. That was a period of high growth, so mid-caps played the perfect innings. Small caps, on the other hand, are the power hitters. Think of these as the explosive T20 batsmen, high risk, high reward. Small caps thrive in bull markets and in liquidity-rich environments, but can crash just as fast. Example, in 2017, the Nifty Small Cap 100 index shot up by 55%. But just like aggressive batters, they can struggle when conditions change. Commodities sometimes are the game changers. These are the unpredictable rain-affected matches. They shine when everything else is struggling. Gold, oil, and metals perform during inflation, crisis, or geopolitical uncertainty. For example, in 2022, oil and wheat prices surged because of the Russia-Ukraine war. That's the equivalent of Duckworth Lewis suddenly deciding the outcome of a game in another way. Investing can feel like a wild roller coaster, right? One quarter, markets are flying high, everyone is making money, and the next, boom. A headline, a war, a rate hike, and suddenly portfolios are in a free fall. What if I told you that none of this has to be random? The markets may look unpredictable, but they do leave clues. Clues that, if you learn to read, help you see trends before they happen. And no, I'm not talking about crystal balls or tarot cards. I'm talking about hard, cold economic indicators, the secret sauce behind market moves. Today, we're going to be talking about 6 such indicators that could tell you what's next for stocks, commodities, and your investments. So get ready, because by the end of this episode, you could be making moves like a market pro. First up is the GDP growth. Think of GDP as the market's energy level indicator. When the economy is thriving, businesses grow, people spend, and investors have reasons to get excited. That's when mid and small caps take center stage. But when growth slows, companies struggle, investors go into the safety mode, and large and mid caps probably sense an opportunity. That's like your reliable, no drama best friends, stable, dependable, and kind of recession resistant. Second is inflation. Inflation means too much of money chasing too few goods. Sounds fancy, but what it really means is that your 100 rupees today buys you less tomorrow. When inflation runs wild, stock markets panic, but commodities like gold, oil, and metals typically love that phase. Why? Because they hold their value. They're called stores of value. When paper money weakens, people rush to real tangible assets. That's why in high inflation times, gold isn't just bling, it could be a king. Third are the interest rates. these are the market's brake and accelerator depending on how it is applied. When central banks hike rates, borrowing becomes expensive, businesses slow down typically, and the stock market slams the brakes. But guess who loves these high interest rates? Banks and financial stocks. Because when rates fall, it's like pouring fuel on a fire for them. Cheap loans, booming businesses, and potentially stock market party. That's when mid and small caps dance their way to the top. Fourth is the volatility index. Now, by now you will realize that the markets are emotional. Some day investors are overhyped. The other days they are scared of their own shadow. That is measured by the fear gauge, VIX, the volatility index. When the fear is high, smart investors typically play defensive, gold and large caps typically gain. When the fear is low, bulls come out for party, and mid and small caps run wild. 5, the US dollar. Markets are not just local, they are global. So a weak US dollar, that's great for commodities, gold, oil, and even metals start looking up. 6 are the geopolitical tensions. Now, equity markets don't quite like wars and fighting. But gold and oil, they typically rally during such times. All right, so let's recap what we learned today. Here is your cheat code, to a market movement. If there is a high GDP growth, think of mid and small caps. If the inflation is rising, think of gold and commodities, they could shine. Interest rates are high, time to look for large caps and banks. When the market fear is high, the VIX is high, consider gold and large caps. The US dollar is weak, watch out for gold and oil rally. And geopolitical turmoil, commodities typically gain in such moments. So no more guessing, no more reacting, just strategic, informed investing. Master these 6 indicators and you will probably never be caught off guard again. History doesn't repeat, but it leaves clues. Let's rewind. 2000 to 2008 was the golden age for commodities, thanks to global infrastructure boom and inflation kicking in. But 2008 to 2013, the financial crisis. You remember the gold skyrocketed and the investors ran for safety. 2014 to 2019, India's economy grew fast and therefore mid and large caps had a good time. And of course, the 20 to 22, the COVID years, liquidity surge, inflation spike, so therefore large caps were the first one to bounce back. Small caps also soared, but a little later, but the commodities went crazy. So what's the best way to play this game? Simple, diversification. Don't just bet on one asset class, keep a mix of large caps, small caps and commodities in your portfolio. Adjust them based on economic indicators, just like a cricket captain changes field placements or the team composition based on the ground conditions. Final takeaways, large caps could be safer bets in uncertain times. Mid caps would be more suitable during economic expansion. Small caps are high risk, high reward, but good in strong bull markets. And commodities is your hedge against inflation and crisis. Stay flexible, stay informed, and don't get stuck playing the wrong shot at the wrong time. So that's a wrap on today's Wealth Waltz with Walunj. Investing is a long-term game. Play it smart, and you can keep scoring runs while avoiding the unnecessary risks. If you enjoyed this episode, then hit the subscribe button and comment with your doubts. I'll try and answer as many as I can. I'll see you next time as we keep waltzing towards smarter, wealthier investing. See you in the next episode.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.